The dust has settled somewhat in financial markets as low volatility hits the US and UK financial sectors. But is this good news? And has increased regulation in the banking sector brought about more stability? Scott Clemons of Brown Brothers Harriman and Company joins me now. Scott, the Federal Reserve and the Bank of England laid out plans to raise interest rates based on job figures as well as inflation. Now, do you agree with delaying an increase to the rates?
You know, central bank policy is always a matter of balancing risks. On either side of the pond, the question is how much risk of inflation do you want to take on while you're addressing the risk of deflation or stagnation in the labor markets? I think both central banks, the Bank of England as well as the Federal Reserve here in the States, have opted to focus on the risk of stagnation in the labor market. That's causing the delay in higher rates. They've basically decided to accept a higher risk of inflation down the road in exchange for combating fragility in the labor markets today. It certainly prolongs this era of very low interest rates, but it's a balance of risk that I think both central banks are wise in making.
Now, let's talk about how this delay is impacting the property sector in the U.S.
Well, there's no question that low interest rates for the past 5 or 6 years now, really, since the financial crisis, have been a support for both the commercial as well as the residential real estate markets. It's allowed for a recovery to take place in both markets. However, the impact on the residential real estate market in particular isn't as great as you might think, simply because access to credit has been constrained. As banks have tightened lending standards, fewer people are able to take advantage of those lower rates. So there has been support for the housing market, but the support hasn't been as great as you might think if all you knew is that mortgage rates had been at all-time lows for 4 or 5 years now.
Now, Scott, how are people turning to investing in currency markets in the U.S., considering that we are in a low volatility period?
You know, Kamuta, we haven't really seen that among our client base. There's no question that investors here in the States have grown frustrated with very low interest rates, and they long for a more normal era in which they could earn a reasonable rate of return on safe assets, such as money market assets or very short duration, short maturity treasury bills or municipal bills. We haven't seen a whole lot of movement into currencies as a way of dealing with that. What our clients have done so far is opt to remain short duration, fixed income, preferring the liquidity that it provides over any sort of return that they might get in other asset classes.
Now, Scott, let's take a look at how some of those issues are affecting the banking sector. Now, officials are hoping to bridge the financial regulatory gap with proposals being tabled at the G20 Leaders Brisbane Summit in November that addresses the kind of too big to fail argument that we've heard over and over again in the news. Now, how do you think that the banking sector in the U.S. is going to react?
Kamuta, I think the banking sector in the U.S. was actually pretty quick at even proacting to enhanced banking regulation, even in the early days of the recovery from the global financial crisis. The Brisbane Summit, the G20 Summit that's coming up, is only the latest step, and it will not be the last step in enhanced banking regulation. So I don't think the impact on the U.S. banking sector is any greater than that which is already anticipated, and to which the banks have already begun to respond. There's no question that it is the desire of regulators to have better insight and better control over the exercise of capital creation. Think about what really went wrong in 2008 in sort of 20 seconds or less. The regulatory environment was designed to provide oversight to the creation of capital. The problem in 2008 is that so much of credit creation took place outside of the banking sector and therefore outside of the regulatory environment. So filling the gaps, as you phrase it, and I think that's the right way to think about it, it's certainly taking place, but it's taking place at such a slow pace, it's given the U.S. banking sector the opportunity to get ahead of the regulatory curve, and I think they'll continue to do that.
Now, the U.S., of course, has had successive bailouts in place that have supported the resurrection of the banking sector. Scott, do you think that banks have learned from their past mistakes, and do you think that the U.S. government is being tough enough?
It's almost a truism of human nature that innovation outpaces regulation. So forgive a slightly cynical response to your question, but there's no question in my mind that the regulatory steps that are being taken by various government agencies will prevent banks from making the same mistakes that they made in 2007, in the run-up to the 2008 crisis. But that doesn't mean the banks won't make all new mistakes the next time around. So investors in particular shouldn't take too much confidence in an enhanced regulatory environment but should conduct their own due diligence on the banking sector in particular as an area for potential investments.
Very interesting. Thank you so much for your insights, Scott.
Thank you, Kumutha. Nice chatting with you.